We have the latest UK unemployment and wage growth numbers due out on Tuesday the 14th of July, and they'll be followed the day after by the latest British inflation figures. Both sets of data will give economists and investors further insight into how the lockdown affected the British economy, as they'll cover the periods up to the end of May and June respectively. On the jobs front, we have had some good news, as supermarkets and food retailers and delivery firms in particular have been scrambling to hire people to help them meet demand and keep the nation fed and watered during the lockdown. In addition, it's to be hoped that Chancellor Rishi Sunak's furlough programme staved off some redundancies and helped firms with their wage bills. Unfortunately, we have seen a big number of companies, public and private, including SSP, EasyJet, Rolls-Royce, Accenture, Casual Dining Group and others, announce staff cuts of late. They won't feed into this set of figures, but the latest batch could show us what the trend is. Remember that in the 3 months to April, the UK unemployment rate was still just 3.9%, near its lows of the early 1970s, as 1.3 million people were registered as jobless, and the employment rate was still 76.4%, just short of record highs. To put those figures in context, the actual unemployed number of 1.3 million compares to some 9 million estimated to be being helped by the furlough scheme. Now, given the uncertain outlook, it was perhaps not surprising that wage growth slowed to just 1%, including bonuses, last time around. That was the weakest increase since September 2014, and those who are in work will be looking at the inflation figures on Wednesday the 15th to see if pay rises are keeping them ahead of the game when it comes to the cost of living or not. In May, inflation as benchmarked by the Consumer Price Index was just 0.5%, while the Bank of England's preferred CPIH reading, which includes housing costs, rose 0.7% year on year. Thankfully, that meant wages were still running ahead of that figure, but oil prices have started to rise and that could come through to the pumps. It may also complicate an already difficult situation for consumers, and therefore potentially retailers and leisure firms, if wage growth starts to lag inflation, as that leaves people worse off in real terms. Company-wise, around a dozen FTSE 100 firms are due to release an update, issue results or host their annual general meeting, and a good few mid and small cap companies will be getting in on the act as well. Do, however, note that the Financial Conduct Authority is giving companies extra time still in which to prepare their statements, so these dates are subject to change. Names which may be worthy of note include gold miner Centamin on Monday the 13th of July, online retailer AO World on the 14th, luxury goods icon Burberry and two more retailers, Dunelm and Dixon's Carphone on the 15th, miner Anglo-American, bookmaker GVC, financial services group Experian and recruiter Hayes on Thursday the 16th, and to finish off on Friday the 17th, another mining giant, Rio Tinto. But for me, the stock that could cause the biggest fuss in the week ahead is Halma, when the FTSE 100 company published its full year results on Tuesday the 14th of July. The share price has been very resilient over the last 12 months, even as the FTSE 100 has fallen by more than 15%. In fact, Halma shares are within touching distance of a new all-time high. The FTSE 100 firm provides a solution to a problem, in that its hazard detection and life protection systems, locks and devices help companies meet regulatory standards and keep staff, clients and customers safe. The mandatory nature of investment in this area creates consistent flows and sticky customers, a combination which gives Halma a degree of pricing power. That in turn can mean high margins, good returns on capital, strong free cash flow, and a growing dividend for investors over the long term. And it's Halma's dividend record that could cause the fuss this week. The analyst consensus forecast is for a full year payout of 16.71 pence per share, an increase of 6% on the distribution for the year to March 2019. If that forecast is met, that would be Halma's 41st consecutive increase in its annual dividend of 5% or more. It would also keep the Buckinghamshire headquartered company in that elite list of just 14 FTSE 100 firms that have managed to increase their annual dividend each and every year for at least a decade, a list from which 14 more companies have fallen this year, to show just how hard it is to keep that run going. Now, on a share price of nearly £23, it still means a dividend yield of around 0.7%. That might not thrill income hunters, but bear in mind that 10 years ago the dividend was just 9.1p a share, and it's nearly doubled since. Moreover, 10 years ago, Halma's share price was 266p. So what would you have thought if someone had told you 10 years later the dividend would be 16.71p a share for an implied dividend yield of 6.3% on that price? Yeah, you might have been a bit more interested. Now, this isn't investment advice with regard to Halma, so please be careful there. But it does show the power of dividend growth when it comes to capital returns as well as income when things work well. You now need to look at Halma's earnings cover for the dividend, cash flow, balance sheet, as well as its trading prospects before you can decide whether that multi-decade dividend streak can run for another 5 or 10 years or more. At first glance, earnings cover looks healthy enough at more than 3 times, based upon a consensus forecast of 56 pence in earnings per share, compared to that dividend estimate of 16.71p. Now, the historic earnings per share progression and dividend cover can be seen on this chart, along with forecasts for the year just finished and the year just begun. Now, besides the dividend and earnings per share, analysts will be looking at the headline sales, operating margin and pre-tax profit figures. On a headline basis, the consensus sales forecast is £1.3 billion, an increase of 10%. The organic growth of rate may be of more interest, and at the first half stage, that was 5% on a constant currency basis. When it comes to the operating margin, Halma's management has a target of 18 to 22% on an adjusted basis. At the first half, the operating return on sales was 19.7%, bang in the middle. And for pre-tax profit, the consensus estimate is for a 9% increase to £276 million on an adjusted basis. For the year just begun, in the unlikely event that management feels able to give any guidance, consensus is looking for flat profits at £267 million. More strategically, watch out for updates on acquisitions, as Halma uses select purchases to supplement its organic progress. At the first half stage, Halma had snapped up 5 firms as part of management's plan to double the company in size every 5 years or so, and it's announced 5 more deals since then. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.